All right, what if I told you there's a government report released every single week that basically reveals the secret positions of the market's biggest players? I'm talking about a report so powerful that some of the world's largest traders have literally fought to keep this information out of your hands. Well, this tool is called the Commitments of Traders Report, and in the next few minutes, we're going to crack it wide open.
Now, this is not just some dry, dusty government document. No way. For those who know about it, this is a source of coveted, almost forbidden, market intelligence. It peels back the curtain on who's buying and who's selling in the massive U.S. futures markets. And let me tell you, the big players, they were not happy when the public started paying attention.
And I'm not just making this up. Get this is a direct quote from 2006. When the U.S. government asked for comments on expanding this report, the world's largest derivative traders, we're talking 725 member institutions, they actually objected. They put it in writing, saying that if you got this information, you'd get a competitive advantage and could trade ahead of them. I mean, that is just a stunning admission.
Just think about that for a second. They are openly admitting this data gives regular traders an edge. So you have to ask the question, what is this information? What are they so terrified of you getting your hands on?
Well, the answer is the Commitments of Traders Report, or just the COT report for short. It's published every single week by the Commodity Futures Trading Commission, the CFTC, and its whole purpose is pretty simple, to give us a weekly snapshot of the actual positions held by the major players in markets, from crude oil and gold to stock indexes and currencies.
Now, here's what makes this report so incredibly powerful. It doesn't just dump a pile of numbers on you. It brilliantly splits the market into these distinct groups of traders, and each one has completely different, often totally opposite motives. Think of it like a market drama with two main characters who are constantly battling it out.
And here they are. On one side, you have the insiders. Their goal is all about hedging risk. These are the folks who actually produce and use the physical stuff. On the other side, you've got the smart money, the hedge funds whose one and only goal is to make a profit. We call these two groups the commercials and the large speculators, and they have completely opposite reasons for even being in the market.
So let's look closer at the commercials. These guys are the ultimate insiders. We're talking about companies with a deep, fundamental connection to the actual commodity. You know, like a giant food company hedging wheat prices, or a major airline locking in the price of jet fuel. They are not trying to guess where the market will go to make a quick buck. They're using the futures market like an insurance policy, just to create some stability for their real-world business.
And on the other side of that trade, the large speculators. This is the smart money from Wall Street. We're talking about huge, highly capitalized hedge funds and professional traders. These are the pros who are famous for using sophisticated trend-following strategies. Their job is to basically take on the risk that the commercials want to get rid of, and in return, they're aiming to make a massive profit.
Okay, so we've met the opposing forces, but how do we actually see their battle playing out? Well, the beauty of the COT report is that it quantifies their collective bets, letting us see exactly where each side is placing their money week after week.
We do this with a little metric called the net position, and it's really simple. You just take a group's total long contracts, that's their bets that the price will go up, and you subtract their total short contracts, their bets that the price will go down. If the final number is positive, the group is net long, they're bullish. If it's negative, they're net short and bearish. This one number gives us a perfect snapshot of how they're feeling.
And this, right here, is where it all comes together. We know the players, and we know how to keep score. By plotting these net positions on a chart right against the price, we can suddenly see a behavioral pattern emerge that is the absolute key to cracking the code of market sentiment.
And when we actually plot this data, the result is just stunning. So this chart here shows the NASDAQ 100 futures market. The price is up top. Now, look below at the net positions. The black line is the commercials, and the gray line represents the funds or the large speculators. Do you see it? It's a near-perfect mirror image of each other. It's a financial tug-of-war made totally visible.
So here it is, the secret pattern, in plain English. The commercials, the insiders, they are classic contrarians. Because they know the fundamental value of their commodity, they see low prices as a bargain and start buying. They see high prices as an opportunity and start selling. They buy weakness and sell strength. The speculators? They do the exact opposite. They are trend followers. They buy when prices are already going up and sell when prices are already falling, hoping to ride that momentum.
So this whole dynamic leads a lot of people to a very common conclusion. a piece of market folklore you've probably heard a million times. Just bet against the small retail trader, right? The so-called dumb money. It seems logical, but is it actually true?
Yeah, that's a total myth. And here's the crucial little detail that most people miss. The category for small traders in the report is called non-reportable positions, but that group is a mix. It includes not only small speculators, but also small businesses hedging their risk, basically small commercials. So you just can't treat them as a reliable contrarian indicator.
So the real edge isn't about fading the little guy. It's about understanding this massive struggle between the commercials and the large speculators. Okay, so you might be wondering, how does knowing what's happening in crude oil futures help me if I trade stocks or ETFs?
That's a great question. It's because these markets are deeply interconnected. The sentiment we can see in the COT report has powerful correlations across all kinds of assets. For instance, the source material notes an incredible 96% correlation between crude oil futures and a stock like Apache Corp. The copper market is tightly linked to the Canadian dollar. And of course, the sentiment in S&P 500 futures could give you a massive edge on the entire stock market.
Now, you might be thinking, hey, the report comes out on Friday, but it reflects Tuesday's data. Isn't that old news? Not at all. We're tracking massive shifts in positioning from giant institutions. These trends play out over weeks and months, not minutes and hours. Trust me, this weekly data is more than timely enough to catch the big moves.
And the best part? You can get all this data yourself. It's a super simple process. Just go to the CFTC's website, find the Commitments of Traders section, and you can download the new report every single Friday afternoon. It's that easy.
So what does this powerful intelligence cost? This data that the pros literally tried to keep to themselves? Absolutely nothing. It is 100% free to the public.
So what this all means is that you now have the key to see the market's battle lines drawn for you every single week. You can see what the ultimate insiders, the commercials, are doing, and you can see exactly what the professional trend followers, the speculators, are doing. The only question left is, who are you going to listen to?